Constructive is the word Chinese officials are using to describe a phone conversation between Steve Mnuchin, Robert Lighthizer, and China's Vice Premier Liu He over the weekend. But reports suggest the president is reluctant, our president, to roll back tariffs. And that's still vexing the chances of a resolution. Joining us with more, Jess Smith, who is in Washington for us. And it almost seems like whiplash back and forth on all of this.
Right. It's another day, another comment on trade to try and dissect. China, as you mentioned, said that the call over the weekend was constructive and that the two sides will remain in close contact. But CNBC reports that a source close to the Chinese government says that the mood is pessimistic about the Phase 1 trade deal. Tariffs are a key area of concern here. The Chinese thought that there was an agreement to lift tariffs as part of the Phase 1 deal, but President Trump has not signed off on that. CNBC also says that the Chinese are looking carefully at impeachment and the election in the U.S. and that their strategy may be shifting to wait and see what happens, keep talking, but wait and see what happens in the U.S. We do know that President Trump talked about China trade with Fed Chair Powell this morning at a White House meeting, but we'll be watching to see if we hear any more from the Trump administration about where negotiations stand. Adam and Julie.
Thanks, Jess. And as Jess has just been talking about, trade negotiations remain ongoing. The lack of a deal continues to plague an otherwise robust market as investors await some type of resolution. Joining us now with more is Will Ryan, Granite Share CEO. Will, when you look at your suite of ETFs that you guys manage, it does seem like there's been some diminishing effect of the trade back and forth. But nonetheless, it still remains unresolved. What's your view on the situation?
Yeah, I mean, it's funny. I mean, I suppose this is the first time in history we've had, something like this played out in real time, and that's, I think, what the market, really kind of fundamentally struggles to deal with. And so before, in history, we'd always have things like trade, major political decisions being done behind closed doors. And obviously nowadays, that's very much in the public eye on a kind of minute play-by-play basis. And,
tweet by tweet.
Tweet by tweet, and that's what I think the market struggles with.
One of the things that you've just done, you launched in October, X-Out. Did I pronounce it correctly?
Yes,
it's a
exactly
U.S.
right.
large cap ETF.
Yeah.
But here's the deal. You are Xing out roughly, 250 companies, and among those were, when I was reading the notes that you sent, Disney. You X'd out Disney. I think you X'd out our parent company as well, Verizon. I'm not sure about Verizon, but Disney's out. How do you determine who's in and who's out?
Yeah, so we have a multi-metric sort of fundamental scoring system that basically scores every company, so the 500 largest companies in the US, and gives them a score 1 to 5. And so the 250 names which perform poorest get excluded from that index. And so we rebalance on a quarterly basis. And obviously, if a company is excluded, it doesn't mean they're permanently excluded. They can come back in if they sort of turn things around according to the model. But that's the basic idea, is that the whole philosophy of investing has always been based around picking winners. And as we know, that's just fundamentally extremely hard to do. And so what we think is there's a good amount of research done that it's actually easier to spot companies that are in decline or most likely to underperform than it is to pick winners.
But doesn't that sort of defeat the whole point of an ETF? I mean, you're sort of like saying we're passive, but no, wait a minute, we're actually active? Are you kind of a hybrid or a push me, pull you, or how do you characterize yourself?
No, it's a great question. Look, I've been involved in ETFs for 20 years, and I think one of the things that in my mind is most important is the ETF is just a wrapper, right? It's just a vehicle to provide an investment that could be anything from physical gold to a specific basket of bonds. And so to me, the wrapper itself, the technology of the ETF is the important thing. What's in it is actually less important.
Fair enough.
And so one of the things that we've tried to do is take what you're talking about, passive investing's arguably biggest flaw, which is buying every company in a market indiscriminately, whether it's a good company or a bad company. And we're trying to X out those that are bad, and we think that's a better way for
get
investors.
The cost savings.
But how do you, why is it any easier to pick the losers than it is to pick the winners? If you look at some of those that you have X'd out, you've got Schwab, you've got Disney, as Adam mentioned. Wells Fargo might be a more obvious.
GE. It'll make Brian swing.
Yeah.
You wrote GE scores quite horrendously.
Stocks. You buy them when they're down.
So what? But what are the? How do you just look at historical performance? What are you looking for?
So, like I said, we look at a number of different fundamental metrics. So we look at things like, is a company growing its revenues? is a company hiring or firing its employees? Is it reinvesting in the business from an R&D perspective? There are things that you could argue that many active managers use in part of their process to evaluate whether a company is kind of good or bad or going in the right direction. And this is what we use. And I think what's kind of interesting is if you look at the market more broadly, the market's pretty good at identifying a company that's in trouble. It's just a lot harder to pick out of all of these securities what's the next Google. I mean, that's just a difficult thing to do.
Within your model, what are your expectations on interest rates?
So we don't have, it's not a valuation-based model, so it's purely fundamental. So we don't have expectations on things like interest rates. All we're trying to do is identify good companies and bad companies and exclude the bad ones.
And we should point out your track record, barely 2 months, not even two months old yet.
Exactly.
You're outperforming the large cap index, but the S&P 500, you're outperforming if someone were to compare.
Correct.
But it's only a month and a half out. So.
Exactly, yeah. No, it's early days. I should say that this strategy was run in a private fund beforehand, so it does have a longer history, but has now been commercialized into an ETF because a lot more people can access the ETF and want that as the vehicle of choice. So although the fund itself has been live for a very short amount of time, there is a broader history behind it.
Hope we can get you back in about 6 months and see how this is all progressing against.
We'll be watching, Will.
Thank you.
Will Ryan, Granite Shares, thank you for being here.
Thank you so much.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.